Ted, thank you very much for joining us. You are our warp engine, so I really appreciate your help, Scotty, in getting us to this moment in the past 2 days. I'm just going to say a couple more things of appreciation to you and to Jim Serenza and to Nina, and your whole team at DNB for really stepping up over the last kind of month as we sort of thought through what would be helpful and contributory to a larger collaborative effort, the word which seems to be on the mouths of everybody. So in fear of sort of embarrassing you further, I probably stop there, but thanks a million. And now I see your team is almost all assembled. So I will step back and leave it to you. You just come back to say goodbye and thanks at the end. Over to you, Ted.
Jim, thank you very much for your kind introduction. I think I see all 5 of the panelists for our next panel. Sebastian, you look like you're upside down. I wonder if you could write yourself over. Anyway, to get started, I'm going to let each of the panelists give a brief introduction of themselves. Amit, could we start with you, please?
Yeah, sure. Hopefully you can hear me. Please tell me otherwise.
Good.
Great. So, hi, good afternoon, good morning, everyone, depending on where you are. My name's Amit Puri. I'm the Global Head of Environmental and Social Risk Management here at Standard Chartered. And my team is part of the Sustainable Finance Unit that we have in the bank. We're part of the front line, and we are focusing on the origination efforts of the bank to drive more sustainable financing. For those of you that don't know Standard Chartered, we are headquartered in London, but we are Asia, Africa, Middle East focused. So we participate in a number of forums and initiatives in Europe, North America, but we try and apply them across our emerging market footprint. And our key sort of philosophy around about ESG at the moment is very much around how do we encourage the transition in emerging markets. I think my colleagues and I say this quite frequently, it'd be great if we can get Europe and Americas to some extent along the way, but if we don't solve for China, India, Indonesia, and the rest of the emerging market footprint that we cover, the world is no way going to meet its trajectory that is required under the Paris Agreement. I'll stop there, Ted.
Okay, perfect. Thank you. Sebastian Blum, could you give a brief intro of yourself, please?
For sure. My name is Sebastian Blum. I'm working for KFW IPEX-Bank, which is a subsidiary of KFW, this German state-owned development bank. We are a commercial bank, and our mandate is to support German and European export industry, German European infrastructure, and also raw material supply. And there's also climate change and environmental protection in our, let's say, mandate from the German government. And that explains why we're very focused on this when we're doing our financings. We have a shipping portfolio of roughly 15 billion euros. So one of the biggest financiers in the world here. And we have tried to promote green shipping already for a while. Supporting different kind of projects, a lot of let's say first mover projects as well, and new propulsion. We are one of the market leaders in retrofit financings, and we try to do our best to support the different industry players here to match or attain the objectives of the next IMO regulation, which should come out quickly, I hope. And then we can also support some European exporters with this. That would be perfect for us.
Thank you. Next, Menno Van Lacum, please.
Yes, hi, Ted. After a long-term banker and investor, we co-founded together with a couple of other people Prow Capital not too long ago. Prow Capital is an investment management company that we set up in order to provide financing to sustainable assets. Sustainable assets in general, but more specific, we expect to launch in Q4 the Green Shipping Fund, which will be a fund providing asset-backed financings to shipping lines, especially the medium and smaller size shipping lines, in order to assist them in their transition towards a greener environment and a greener fleet of vessels. Again, we expect to launch in Q4, and we hope to assist the shipping lines to navigate through these technological, regulatory, and market uncertainty due to decarbonization. And that is actually what we're trying to do, is set it up in such a way, and I can elaborate a little bit further on that later on, but it is the goal to be a non-typical private debt fund in terms of funding cost. So we hope to be able to offer financings at cost similar to traditional bank financings.
Thank you. Nina Ahlstrand, please.
Yes, thank you, Ted. Hi, everyone. Very nice to be here. Nina Ahlstrand. I'm heading up our sustainable finance team within DNB Markets. So what we do is that we try to help clients receive financing both via bond and loan markets for sustainable investments and projects. I'm based in Stockholm, but I work across our different offices globally. And with DNB's very strong history within shipping, we actively seek ways of supporting the industry in its decarbonization journey. And just to name a few examples, we're one of the founding members of the Poseidon Principles. We're an advocate of the responsible ship recycling standards, and also a member of the Getting to Zero Coalition, just to name a few examples. But very excited to be here today and looking forward to an interesting discussion.
Thank you, Nina. And Julian Proctor. Good evening.
Can you hear me?
There we go.
Perfect. So I work for an asset manager called EnTrust Global. To many of you, you may know it in ship finance. We have a sizable business. We raised roughly $2 billion on the credit side of our business. EnTrust is an asset manager of about $20 billion, so we're a sizable business. We've just launched the impact fund, which I co-portfolio manage together with one of my colleagues. And our focus really is to help to decarbonize the shipping industry by providing equity to large ship owners, ship operators, predominantly through joint ventures, and really assisting them to purchase low carbon ships. And that means LNG, dual fuel, LPG, dual fuel. It could be hybrid electric in the ferry sector. We have a very wide lens and remit in terms of how we ultimately invest. So we're looking forward really to work very closely with many of the banks here today, DNB and Standard Chartered Bank and KFW, because they're key partners of ours as we work ultimately with some of those large ship owners and ship operators. So we're also looking forward to working with a lot of you out there as well. So thank you.
Thank you, Julian. So the first question I want to ask, I'm really going to direct to both Menno and Julian, both involved in raising new funds from investors to invest in green shipping, broadly categorized. Could you give us a feeling for what are prospective investors' appetites for the type of proposition you are marketing and their main concerns? And is there a particular kind of investor that you are targeting, and what kind of return hurdles are people looking for? Menno, maybe we could start with you.
Yeah, I think the interesting part is that we are really setting up a debt fund, whereas Julian is on the equity side. So I think it's two interesting angles to the same topic.
Yep.
I think interesting enough is that the industry is challenged by retrenchment of banks, less capital available, and the typical private debt investors, I would say, have yield requirements that are above the operating yields that are being made by shipping lines. So the traditional risk return metrics, I think that, or the perceived risk return for shipping, is probably at the end of the spectrum that does not necessarily justify the actual risk return that a solid portfolio of assets should have. So I think that our goal with the Green Shipping Fund is really to be a bridge between the traditional bank funding, which is going to be less and less available due to regulations and other reasons, and the debt capital markets. I mean, if you compare shipping to aviation, if you compare it to container leasing, if you compare it to railcar leasing, it is in a way a lot of the same metrics. but with a perceived different risk return metric. So to me, the actual cost of funding for debt facilities are at the high end of what it should be. And so I think we collectively as an industry should try to get more to standardization, more of a securitization style business, where we kind of, as the Green Shipping Fund, try to build a warehouse together with government support at this juncture, which I think is extremely important in the decarbonization. I think we expect from all participants in the shipping ecosystem to be collaborative, innovative, constructive in reaching its goals. And I think also on the financing side, we have been trying to set together or to try to put together a cooperation between commercial banks, private investors, and the government, which I think in this transition is an extremely important aspect to make the transition really work. So I think that maybe it's not necessarily a direct answer. What is the challenge? But the challenge is really to keep the cost of capital low in order to make the transition work. And by collectively structuring it in such a way that shipping will be eligible for the debt capital market systems, that I think is the future. Because private debt funds are not the future. Traditional bank funding is not the future. Really, we should work towards a bridge towards the debt capital markets. And that is, I think, when, together with equity people like Julian, we can create a weighted average cost of capital for shipping lines to make the business work. So maybe Julian on the equity side.
Thanks. Thank you, Menno.
Yeah, and thank you for that, Menno. It's good to see a familiar face, and for many of those out there, we used to work together many years ago. We're in a very fortunate position. We can now invest. We've raised several $100 million already, and we're actively looking at investments now, equity investments in the industry. And our goal over the next several quarters is to raise much more than that. Our targets are really quite substantial, and that's largely because, and it's been said many times and said well today, that the amount of dollars needed to decarbonize the industry is substantial. There's been estimates of several $1 trillion of capital needed over the next several decades in order to ultimately decarbonize. And the question is really, where does a lot of that capital come from? And it's not an easy question, because as we all know, the banking markets have been going through a state of flux. They're increasingly focusing on large corporates, which is, by the way, the same area that we're focusing, which is larger companies. And the equity markets have been tough. And I think, Ted, you would certainly agree that it's been a tougher 2020 and a tougher 2019 than it was at 2014. So people like us, which take a long-term view on the industry, because we've been doing this business for decades, it's all we've ever done. Not only do we have the industry expertise, but we also have the perspective, and in our case, we have long-term capital, which is really important. I think we're going to find that we're going to be a great partner, equity partner, mostly through joint ventures with ship owners and ship operators, as we help them acquire those low carbon ships. In terms of the institutional universe, it's everybody you would expect. It's all of the. There's no surprises. We have a phenomenal team at EnTrust which looks after that fundraising process, and they do a great job. We have hundreds of different institutional clients, but what I would say is it's the pension plans, it's the endowments, it's the sovereign wealth, it's the large family offices which ultimately support us and allow us to look after their money and invest in a very wise and careful manner.
Would you say there are people that generally have broader mandates, or are they people with more specific ESG mandates, Julian?
The institutional investors, they're not sacrificing financial return because there's ESG benefit. And to be really clear, we're an impact investor. So for those that know the differences are really important. You have ESG investors, which they can use a variety of different filters to say that's what they do. but frankly, there's a lot of greenwashing in the industry, as we know. We're very different. We have very clear, measurable, identifiable impacts that we can report on, because generally we're focused on how do you reduce carbon emissions. I mean, that is the key focal point for us, which is how do you reduce the amount of carbon emissions that the industry is going to be emitting and does emit over the next several decades. How do you solve that challenge? And that's something people find very interesting. But what I would say is that the financial returns are really the key component. So there's very little sacrifice. There's not really a trade-off there.
Got it. Thank you. Amit, I'm going to turn to you if I could. You touched on a bit in your introduction. I think we hear a lot about the focus on the ESG issues certainly in Europe. It's becoming more prominent in the States. But as you said, it's critically important that the markets that your institution is really focused on are also part of this development. How do you see it? Where does it stand right now? How can you describe the interest and the focus of the say the emerging markets where Standard Chartered is really focusing its business on these issues?
Yeah, sure. So I think it's fair to say, as you just mentioned, Ted, that it's certainly more nascent in emerging markets. We've been in emerging markets as a bank for 150 odd years, and so we've got a lot of context and history. And I think, from personal experience and being in the bank a long time, we've seen a real focus and energy and drive towards ESG across emerging markets as well. The regulatory framework is trying to catch up as quickly as possible. I mean, this more broadly, not just across shipping, but it's still got some way to go. The issue that we find that is sort of impeding in some ways is the balance between infrastructure improvement and development and sort of essentially making basic services available to people in emerging markets. And how do you go about doing that in a way that you can leapfrog certain technologies that the West has had access to for a number of years, but is now essentially trying to phase out. So, we've all had the benefit of coal-fired power for the last 40, 50 years. We're denying people in emerging markets reliable power because we're saying we don't want to give you coal power. We just want you to leapfrog into renewables. And so there is a bit of a sort of a social dilemma that we are having to face. But saying that, we are finding that there is a huge demand at the client level. So our clients who are looking for capital are happy to engage with us in conversations around how we can sustainably finance them. We've done some transactions recently where we've managed to get KPI type loans available to customers for financing ships, and we can just see that growing and growing over time. I think capital users in our market are certainly realizing that the way that they're going to continue to encourage capital or to have access to capital is really to follow a strong ESG path. I'll address one point just in case anyone's wondering. Standard Chartered is currently not a member of the Poseidon Principles. We totally appreciate the work that gets on, but we aren't a member, and you can look it up. It's obvious. Why? And a lot of it comes down to data. We are struggling to find the data for the vessels that we finance in order to be a reputable partner or adopter of the Poseidon Principles. 30% of our portfolio is EU flagged, the rest is emerging market. So while the IMO DCS scheme does make data available, it doesn't make it available as freely as it does in the EU. And so we are actively trying to find ways of working with our clients to encourage data transparency, data reporting, because ultimately we know we need that. Other banks will need that in order to continue the flow of capital into emerging markets as well.
Thank you. Interesting comment. Sebastian, if I may, I would like to get a little bit more into how KFW is approaching, the ESG issues. And as an institution, you've had a very long track record in financing the maritime sector. You mentioned the level of the portfolio today, and it's my understanding it's a very broad-based activity across, really a broad range of shipping sectors. Going forward, in your shaping the future strategy, you expect the bank's activity to be more limited in terms of the sectors you're involved in, or types of vessels you'd be financing, or do you expect it to continue to be a more broad-based strategy?
First of all, maybe a sentence on KFW sustainability strategy. So there's currently a process running on a group level, doing a kind of a roadmap to sustainable finance, breaking down then the objectives to the different business areas and so on. And we are just working on this currently. That's also one of the reasons why we haven't subscribed to the Poseidon Principles at this point in time, because we need let's say the big objectives first, and then we can see what we can commit to on a business sector level. And then I think Amit mentioned a very valid point on the data. I think we're very eager to see the first reportings here, and then we have been monitoring our fleet already for a good while. So we have since 2014 we have been evaluating all the EDs of our ships we're financing, so we know what comes into our portfolio very well, and then for sure it's benchmarked if you finance a new ship towards the curve the IMO sets, and then also towards the rest of the portfolio. But it's not live data, so I think that's a reference point, but not something where you then know how the ship is operated and so on, and that plays an important role, as we have heard from previous speakers as well. So saying this, we have always focused on very efficient ships already. So I think that's something where we have a focus on export. So there's always a kind of a new build involved. It's a lot of European shipyards we are financing as well. So it's a lot of cruise ships we have financed in the past. At this point in time, we say, okay, we want to follow our European clients and the European interest, European link, and we do not cross out sectors. But there's a natural match where you have a lot of European interest. There's a lot of financing from our side. So it's around 50% of our portfolio is cruise, and you have a lot of ferries, containers, it's tankers, gas and oil tankers. Then you have offshore energy. This includes oil and gas related assets, mostly toward the end of the value chain, so FPSOs, and then vessels to build offshore wind parks as well, and very few bulkers we also have, because it's not that many equipment on a bulker, and mostly they are trading then between Asia, South America, and so that's a small part of our portfolio. So for the moment being, I would not cross out any of these sectors. We try to find our European link. We try to follow our clients here, and then we can do this and have a look at every project. How this might look like in 5 years' time, I think it's difficult to say, as some other banks also already have taken decisions on crossing out certain sectors, as we have done also on the energy side, coal, for example. But for the moment being, we're open, and then try to find the most efficient and best projects here.
Thank you. Nina, let me turn to you. We've heard, over the course of several of these panels we've had over the last few days, and certainly some of the speakers earlier talking about the importance of collaboration and the involvement of governments, in the process, in the journey here. Could you talk a bit about the evolving EU taxonomy on ESG and sustainability issues and regulations, and how this will impact or is impacting both borrowers and investors?
Certainly, and I would say sort of the EU taxonomy is one of the topics at the top of our agenda at the moment. And as I'm sure you're aware, I mean, the EU has set a very ambitious target in 2050. The Union wants to be climate neutral. To get there, we of course need vast amounts of capital to be invested in sort of a more environmentally friendly direction, or a green direction. And to enable that, sort of the first step is of course also to agree on what is a green direction, and that is really where the EU taxonomy comes in, and it can be called sort of a classification system, really, where about 80 different economic activities so far have been defined within 8 sectors, with specific technical screening criteria to define when one of these activities can qualify as green. And this comes down in the end to reporting requirements. Investors will need to report on the share of their holdings that are taxonomy aligned, and companies will need to report on the share of their turnover and their investments that are aligned. And in the end, this is of course an EU regulation, but it will also impact companies and investors outside of EU borders. Because if you're a fund, for example, and you're offering financial products within the EU, even if you're based in the US, you will come under this regulation, and you will need to report to be able to give your investors within the EU that type of information. So it definitely has a very broad reach. Currently, shipping is not one of these 8 sectors that is included. The sectors have currently been chosen according to their share of greenhouse gas emissions within the EU. So it's said that the current taxonomy should cover about 93% of those emissions. So of course a large share, but there are certain sectors still that are left outside. But we do expect that many sectors and additional activities will be added fairly soon. Would not be surprised if we saw criteria coming into place perhaps in 2021 when it comes to shipping, for example. And I would personally expect those criteria to be very much in line or sort of referencing the IMO's targets when it comes to the 100% reduction trajectory towards 2050. And also what we currently see in the taxonomy when it comes to transport in general, it's mainly based on land transport, but looking at transport and also storage for that matter, that is that anything that is sort of dedicated to fossil fuel transport or storage is automatically excluded at this point in time. So I would expect a similar criteria to come into place also for shipping. And as a final note, I think it's also important to say that yes, this is a definition of green, but it doesn't automatically mean that an activity falling outside of the taxonomy is automatically brown or sort of not having a clear role in the transition. And I would also expect that there's fairly limited share today of sort of the investable universe that would actually qualify in line with the taxonomy. And it's still, of course, very important that we can't see this as a way of now we're only going to invest in what is already green, what is already taxonomy aligned. It remains very much important to invest in the transition so that we sort of have more of the green tomorrow than we have today. But I think from an investor perspective, it will also be a communication challenge also to, just because something is not taxonomy aligned, there can still be a scale when it comes to the environmental performance of different assets. And it's in my mind fairly tricky to view this as a binary topic, as either you're green or you're not. There's definitely different shades when it comes to this discussion.
Thank you. Thank you. Menno, I'm going to go to you if I could again. And I'd just like you to maybe describe in a little bit more detail, maybe the type of company that Green Shipping Fund would be focused on, and how do you see, what mechanisms do you see available to kind of bridge that gap from where the market is today to where you think it needs to go in the future, which I understood from your comments was really more of a debt capital market being a primary provider of debt capital to the industry.
Right. I think maybe to start with what Green Shipping Fund is targeting, and the target customers are very much to Nina's point. We are trying to be agnostic as it pertains to what's right and what's wrong. We are in a transition phase, and we're trying to accommodate those parties that are actively thought leaders in the transition phase. So our investments could vary between different asset classes, such as bulk containers, even tankers and offshore, to the extent it helps the transition. And within those asset classes, we provide asset-backed loans for a very traditional bank type of financing, where we really try, because of this transition to debt capital markets, we're trying to build a structure, a securitization-like structure, where we see some sort of level of standardization, i.e. visibility of cash flows. And that is through long-term charters. So I also think that the charter parties, especially for the medium and small size companies, play a very important role in transition, because if the charter is prepared to, for instance, provide longer contracts, it's easier to finance, and we could lower the total cost of funding. So the standardization of assets is also something that I'm pretty keen on. which probably provides more visibility of cash flows. So those are the type of asset classes within the medium-sized shipping companies that we're trying to finance. And I think it is to everybody's point, but the ESG side is really important. Our environmental angle is some sort of arbitrary definition, and that is that we want our vessels, or the vessels we finance, to be 20% cleaner than a comparable vessel propelled by MGO. And again, we are pretty agnostic, so it could be hybrid, it could be biogas, ammonia, hydrogen, methanol, we don't know, and nobody knows. But we are actively supporting those companies in the transition phase. And so as it pertains to the E, we are relatively keen on this definition. We also take the S and the G into consideration in our investment decision and our risk assessment, with more of a holistic nature. So what we've done is we have developed a scorecard as it pertains to the S and G, and we rate our customers. And so we believe that, to your point in how do we transition towards more of that capital markets, if we are able to define a pretty, I'll say, standardized asset class that we have to make out of shipping within ESG, I think that is going to be extremely beneficial for all parties involved. So that is really what's the core of our risk metrics.
Thank you. Julian, Menno mentioned visibility of cash flow, and how will the impact fund be looking at that issue in terms of the investment decisions you expect to be making?
A really important part of what we do, Ted, is really try to drive down those emissions, not only CO2 but also air pollution, as well as focus on metrics such as whether or not the partner, the ship owner operator, is working in a ethically responsible way as regards to plastic waste, and ultimately how they dismantle the ship, right? There's some very strong environmental considerations. You probably read in the press as well recently that crew welfare is it's a really important issue. It has been for many years. The good news is that I think finally somewhat of a spotlight is being put on that issue, and we care about that too. So I think we take a broad view. I think it's a big E, and then we also think about social and governance issues as well. But we're predominantly an impact investor, and what I would say, just to hit a few points that Menno said before, we're predominantly focused on larger ships. The reason being, it's economics. The bigger ships, they can take the extra cost of these fuel systems and the various energy saving devices which are needed. So in the dry side, it's the larger bulk carriers. In tankers, we're more focused on the bigger clean vessels and chemical tankers. And so across the spectrum, we're really focused on the larger ships. There are some areas where we also focus on more medium-sized vessels, offshore wind and environmental remediation, ferries. These are large capital items anyway, may not be so big, but they're very capital intensive. So really, for us, it's all about, does the business make economic sense? And I think increasingly the trends, the drivers are there. The customers, the end users, they've clearly made up their minds. So if you look at what's happening with mining companies recently, the energy companies, as they're now called, as well as the global brands which use the space on container ships, they've made their mind. They've made it very clear to everybody which way we're going. And I think we also saw a big stamp this month from the European Union as well, which is giving us another signpost, which I think is going to make it a little bit easier for us all to invest over the next several years. So for us, larger assets and larger corporates.
Thank you. Amit, how do you see the role? Menno mentioned he sees a declining role for banks in the the supply of debt to the industry. How do you see that from your institution's perspective?
I disagree, actually. I mean, I think, you know, to the extent that as a bank, we continue to have appetite for the sector overall. So, you know, let's forget the environmental aspects for a moment. You know, we have confirmation. We used to have a debt and a leasing portfolio, but we're now focusing very much on the debt portfolio. So it remains one of the key strategic sort of components of our offering that we will continue to do shipping finance. What I think you will see more and more, and we are making a concerted effort, is to finance the transition across all of the carbon intensive sectors that we have. Our portfolio to a large extent is concentrated in traditional brown sectors, so oil and gas, mining, shipping, aviation, etc. And Standard Chartered, and to be fair, a number of our peer banks as well, are all making bold commitments around financing the transition. I think, you know, to the points Nina was making about the taxonomy is an interesting piece of legislation, but it does have a narrowly defined set of economic activities. There's a lot of activities that fall outside of that are dying out for capital. The label for those, I think we're all adopting, is the transition activities or the transition finance. You know, we, as I said, just talking for Standard Chartered for a moment, we have a huge appetite for financing the transition in emerging markets. So from a shipping perspective, what does that mean? Is that more efficient ships? Is that types of fuel? We are open to the possibilities. You know, we haven't closed the door on any particular technology or development that we want to finance, but we need to see some track record. So, you know, our credit officers aren't going to just sign off on any new technology. They want to see track record, and that's where I think, you know, to Menno's point, that's where you see some tension effectively in the system, where we want to do it, but the technology is nascent in some ways. It's not proven. We're not sure what the cost and return on capital is likely to look like, and that is essentially what is taking some time. And I think there was in the earlier panel, there was a comment made about public capital. You know, public capital can play a really important part here to encourage private capital to lend itself towards these new and emerging technologies. So I think, you know, philosophically, we all want to do it, and we all know we want to direct our finance towards it. But at the same time, we've got shareholders and other, you know, commitments to meet, that we can't just, you know, give money to new technologies unless they're proven. So it's sort of disagreeing in some ways with Menno, but also agreeing that, you know, it's not, we want to do it, but it's actually not easy to do it right now.
Sebastian, I wonder if you could talk in a little bit more detail about KFW's financing program when it comes to retrofitting of vessels. I thought the comments from Ahlstrand earlier were very insightful on the benefits there. I wonder if you could speak to that.
Mm-hmm. Yeah, I think I bought Arlie's elevator pitch from the beginning, because we tried to, let's say, sell this idea already for some years as well. To be honest, with not a lot of interest at the beginning, because there was not regulatory pressure, and after the oil price collapsed in 2015, where we had already started towards energy efficiency measures. So we had a big propeller financing, for example, but then these efficiency gains were just not paying off the investment. And then, yeah, this fleet retrofit idea, yeah, we had to promote it further, but now it really gained momentum with the IMO 2020 legislation. So we finance a lot of scrubbers, and I think our retrofit portfolio should be around 700 million euros at this point in time. So it's quite substantial what we closed during the last years here. For sure, you have to see how you put this kind of financing into a balance sheet of a ship owner, because we already had this discussion as well. There's a mortgage already for the existing financing, and then for sure you can do a top-up maybe with all the existing lenders, or you have to develop something new. And then what we try to use here is a lot the ECA support for the manufacturing goods, which then are coming from a lot of European countries once again, so northern countries, but also Germany, France, and so on. So we can use the ECA support to enhance the credit and take some of the risk, which for the bank maybe would be difficult for not having an asset behind. Then you have just to see how you put this into the balance sheet, how the different waterfalls are, whether there's an RCF or whether there are maybe some older ships available you can use as guarantee here. So it's really something where you have to look at the individual balance sheet, talk to the company, and then try to find a good way to structure it into the balance sheet, and then it can work. To be very honest, you need a kind of a sizable balance sheet here, and then so it's something which can be more used by bigger ship owners, and also you need a kind of a sizable investment program here. That it makes sense in terms of volumes to do this. But for us, it has proven to be a very good idea to, let's say, promote this and pitch this towards the ship owners, and then it works. It works well. I think I saw a statistic of I think it was the BW LPG. They just compared the CO2 emissions for a new build compared to the LPG retrofits they are doing now for their gas tankers. And their calculations that they would need 35 times more CO2 for a new build compared to a retrofit for this vessel. And I think that just shows what others have mentioned before. You have to really look at the whole CO2 emission of the chain from producing the vessel until scrapping it, and do a all-in calculation. And then normally you can convince people, and especially if you have now maybe also an index on the XC, I think it's called, on the existing fleet. You have the Poseidon Principles, pressure here, and then the IMO. Then I think it's something more ship owners will consider, and then we are happy to try to find a good solution here.
Oh, good. Thank you. Nina, you spoke on yesterday's panel in some detail about the TK shuttle tankers green bond that the DNB was involved in some short time ago. In light of that experience, what would be the key advice DNB would be giving its shipping clients in terms of accessing green or sustainable pools of capital, debt capital?
I think in general, and this is not necessarily specific to shipping, but I think in order to access capital going forward, I think it will just become more and more important to have a clear strategy when it comes to sustainability in general, and also including clear, preferably quantitative targets with relevant benchmarks to really show where you are aiming to go, and in addition also some form of communication on how you aim to get there. It's very nice to have a target, and as has been discussed previously today, it's not always easy to know what you actually need to do to get there, but just showing that you are actually aiming to find the best possible solutions. And I think in sort of key learnings from the green bond you mentioned, I think it's definitely that if you have an ambitious strategy and you have a clear communicated target of where you're going, then a green or sustainable label can definitely have a very valuable, it can be a very valuable part of your communication to sort of strengthen that strategy. What I think that you should, however, always be mindful of, that as soon as, even if you're best in class within your part of the industry, as soon as you place a green or a sustainable label on something, you definitely attract more attention, but you also open up for more scrutiny, and possibly or presumably also from stakeholders that would otherwise not have sort of been involved in the discussion. And even if you were best in class in your segment, once you have the green label, you will also be compared to the wider green market, and then you might not be best in class anymore. So then I think it's very important that you have a clear strategy. You can really motivate why you have this green label, why you think it's relevant to investors, and I mean, getting the green label in the first place it's not easy. It's a proper certification process, but in addition to that, you must be able to show that you have a clear sustainability strategy. And what we always recommend clients, and this is not necessarily only for green bonds, but just for bonds in general, include information on what you're doing, especially in this case on the environmental side. And if you have a sustainability team or a sustainability specialist, which many companies do today, invite them to the discussion, invite them to actually have a dialogue with investors to explain these things. It's not necessarily so that the finance team at a company knows all of these relevant details, but investors are becoming more and more sophisticated. They will ask complicated questions, and it's definitely valuable to bring in the right people, the right expertise that you most likely have internally in your company, but that you have not maybe in an active way included in the discussion with investors and banks for that matter as well. I think that is sort of the key message from our side.
Thank you. I think we're getting down to the short strokes here. I'd like to ask one more question that I'll really give everybody an opportunity to comment on. Ship owners come in all different shapes and sizes, or say shipping companies. Definitely heard some comments from the panel yesterday on the benefits of scale, the benefits of size in terms of being better positioned to finance the investments that are ahead. And I just wanted to ask the panelists, you know, is bigger better in the context of this conversation, or is that not necessarily the case? Julian, let's start with you. You're on mute, I think.
Can you hear?
There you go.
Great. So I think I think it largely depends about where you're touching the ultimate end user and customer, because they're driving so much of the stakeholder pressures with regards to the end users, is that you have to look at those linkages. So if you think about ferries, which is the most obvious area, we're dealing with people. And when people get on board a ferry which is emitting huge amounts of dirty, heavy fuel oil, in their minds, it's a very visual picture. So, and that's what we've seen. We've seen the change occur most rapidly in the short sea ferry routes, and we've seen obviously happen in Norway and in the Baltic as well. So it has been rapid change. And if you compare and contrast that with some of the sectors, let's say in the smaller sizes or the medium-sized bulk trades, and they can be going to various countries in the world where they might be dealing with much smaller commodity intermediary, the pressures are much lower. And those customer stakeholder pressures are really important. So I think it really depends on how close to the end user you really are. If you're dealing with one of the big global brands I mentioned before, some of the big guys at Puri and Nike and Adidas, it's very clear. You just go to their websites and it says it all. And the pressure that they put on both the non-vessel operators like a Kuehne + Nagel or the liner companies, it's increasing. So you've got to think through those pressure points when asking which parts of the shipping sector are going to be moving first. And then I think you can get down to questions of economics as well. Does it actually make sense? So to us, we really look at it. It's all about what are the end users doing, what are the stakeholder pressures, and I think that really drives so much of the discussion, because the regulatory landscape, whilst it's hugely important, and we've got targets and we've got some really important milestones put in there, I think it's going to be the big end user customers, the market, which really drives this change over the next several years. I'll just put that.
Menno, how about you? Would you comment on that, please?
Yeah, I'm not disagreeing at all with what Julian is saying. I mean, the question, I guess, is what is better, right? I mean, better in terms of having a broader perspective to the world, having more infrastructure, being able to service the end users better, which means you can be cheaper. Clearly, bigger and better in many different ways. At the same time, and especially on the shipping side, you see still, I don't know exactly the percentage, but there's a large percentage of mom and pop companies. There's a large percent of smaller businesses. Yes. And I think we should, especially in this transition, we collectively should have a focus on these medium and smaller sized companies, because in the end, they will drive the true transition to decarbonization. And so the bigger guys, they are somewhat slower, obviously, but they've got more money to put into venture capital. So we need the bigger guys to be a little bit more innovative. Take the big container guys doing LNG type of transactions, fantastic. Let's see how it works out. But at the same time, we also need to focus on the medium-sized companies. So I think, you know, is bigger better? I think big is very important in order to drive the smaller guys into the transition as well. So it's the combination really that collectively we should focus on, I think.
Amit or Sebastian have a view on that question?
Go on, Sebastian.
Amit, take it.
Okay, so I think just from my perspective, I think, you know, and it's building on something that Nina said about verification and environmental sort of indices, and I think the bigger you are, to some extent, you have the capacity to absorb the cost of some of the verification that needs to go in, some of the data processing and the systems that capital providers like ourselves are going to have access to in order to give you that preferential treatment in terms of capital and transition finance going forward. But I fully agree with Menno that essentially it's going to be at the SME level, you know, that we're going to see the biggest difference. And so we need to find a way that while you're getting the big players in the industry to move to becoming more sustainable over time, and that is happening because of the shareholder pressures, etc., that they're facing, actually to affect global change, we need to make sure we take the smaller and more medium-sized companies along with us as well. So I'm not answering your question, is bigger better? I think bigger might be easier in some ways, harder in others, but that's probably my view on that.
Thanks. Thank you.
That's exactly what I wanted to say. It's not bigger is easier for us banks, especially with all the regulation, and then we have the balance sheets. You know, they can maybe try different kinds of fuel. They have a kind of a level playing field, and I think one of the tonnage providers I've talked to recently said, okay, you know, I can't be the first mover. I depend on the others to take my ships, but I can be a smart follower. And I think it's about this, you know, you have to monitor closely what's happening there, and then try to find a good solution to do what you can in your field. And we finance also mid-sized companies. They're normally active in a niche. They have a solid business model. They have some long-term charters. You know, they're focusing on fields where maybe the bigger guys are not that interested in. So there is a field. Also, those companies, they are innovative. They try new things, and then they for sure they have to bear the cost for the transparency and everything. But I think there are ways to finance them. And then you have the different pockets of capital. Maybe it's then not the banks, but it's some others who can step in here, because for sure we are guided towards pro-cyclical financing from the regulator side. If I go to my security guys and tell them about a new technology, then they say, nice, we do a discount of 30% because there's no infrastructure and there's no market value for this. So it's difficult unless you have a balance sheet or an ECA cover as well. That helps.
Thank you. Thank you. I think we've run our allotted time. So Jonathan, I'm going to turn it over to you to see if there's questions from the audience.
There are questions. We really don't have time to go into all of them, but I'm going to try and tap a few of them and maybe you can help direct who you think would be best to answer this.
Okay.
What role will charterers play in helping finance the transition?
Let's have Julian talk to that one.
You know, they're really important. If you think about what I said right at the beginning, it's all about the customer. The customer is the end user, and the end user will drive all of this change. You know, Sebastian said it well. He has a medium-sized ship owner which doesn't know what to do. Well, the medium-sized ship owner, the lower-sized ship owner knows what to do, and the customer tells him what to do. Now, the question is whether or not it's a fair deal between the ship owner and the charterer. And I think what we're seeing is that the benefits between what the end user gets and what the ship owner gets is becoming a fairer deal. And that's coming in a number of ways. It's because the end user is generally a bigger guy. He's got a bigger balance sheet. It's more creditworthy. He's prepared to go in for longer durations. As we probably all know, it's a short market right now, other than for probably people in the dual fuel space. And you'll also probably get a slight premium. And we can debate back and forth what that really means. But the charters and the end user, let's not even say the charter, the end user is the most critical part of this entire discussion. And the ship owner is really just it's not to undermine, it's following really those demands.
Does anybody else want to jump on that question?
Everything said, I would say.
Okay, well, this one here is, I think, for Julian as well, but maybe others can jump in. So what are some of the measurable metrics that you are reporting to your LPs? You were talking about reporting, I believe, when you were discussing impact investing. And so they were just like specifics around like metrics is the question.
I would broadly say we're an impact investor, so the important elements are carbon dioxide and emissions reduction. That's one of the most important elements which institutional investors care about and want to see demonstrable and measurable reductions as part of that process. And I think when it gets to CO2, there's obviously the technology there, there's the data there, the quality of data as well. So I think that's something which we can show in a consistent and independently verifiable way as well. So, but I will leave it there. I think that's probably enough.
Okay, and then I think maybe finally, this is kind of more of a general question. So solar, wind, and even Tesla were given boosts from tax breaks, but shipping doesn't pay tax. How can this be overcome, or how can we learn from this?
Exciting question. I think in general, sort of looking at the ESG space broadly, it's of course, and just as a reference to the EU taxonomy, in the end, the aim here is to shift capital in a specific direction and sort of creating incentives for that. And I would say sort of where the taxonomy is at now, and then also looking at increasing demands from investors, it's sort of about reporting and what gets measured gets done. But I definitely think from an EU perspective, if they see that capital is not flowing in the right direction, and this is of course not sector specific, but very broadly, it has been mentioned that tweaking capital requirements, etc., for banks could of course be one way going forward. If that is in terms of sort of a discount on green assets, a penalty on non-green assets, that remains to be seen. It has been heavily debated, heavily criticized that capital requirements should be about credit risk. But of course, climate risk comes into credit risk as well. And if we don't take that into account properly, then perhaps that we will end up down that route. I will leave it with the EU to clarify on those terms, but I would not be surprised if we saw something on that side if they do not think that capital is moving as they want to with new upcoming regulations. So that was not very shipping specific, but sort of in a general sense.
Fantastic, thank you. All right, then I think that, Ted, I'm going to hand it back to you to wrap up this panel, and then I'll bring Jim Lawrence on.
Very good, thanks. Well, panelists, look, it's been a very interesting discussion. I think there are 3 new faces here that I've met, so that's a great opportunity for me. Pleased to meet those new faces. Some new sources of capital, some existing sources of capital. Tells me that this transition is going to attract money. The opportunities that are going to come from this transition are obviously going to require capital, but it certainly seems to me like it's already begun to attract capital to meet the demand. I think for that we can be encouraged. I think it's been an interesting couple of days, and you know, a few comments or words that kind of jump out at me because we heard them a lot. Opportunity and embracing the opportunity, the transition. It's not a black and white type of differentiation here that capital providers will have to make. There is a transition. that transition will need capital, and it will create returns. Transparency, and I thought interesting from the ship owner's point of view, the whole discussion around capital allocation and the need for clear guidelines in order to make what are significant decisions in terms of dollar amounts. So I think that's my short sum up. Panelists, again, thank you very much for your inputs. And Jim, I'll turn it back to you.
Ted, thank you very much. And Amit, Sebastian, Nina, Julian, it's great to see you. And thank you so much for your contributions today. I'd just like to say in conclusion that the past 2 days have been inspiring, and that for Marine Money and the High Tide Foundation today, we look forward to contributing in any and every way we can to support this vital transition. All of us on these webinars during UN Climate Week should know that we have added our voices to literally hundreds of similar conversations that are taking place on webinars covering every conceivable industry, municipalities, engineering firms, and technologies, as collectively a universe of collaborative commitment to mitigating climate change marches inexorably forward. So as we look around the globe at the effort, we can, I am sure, be very proud of our steps today and the role that finance will play tomorrow and the years ahead in the transition. But there is obviously a lot of work ahead of us. So thank you all, our valued sponsors, our partner DNB, our speakers, all of the people behind the scenes who've helped make this work, and to all of you who've joined us, whom we can't see, whom we only wish we could. Until next time, thank you all very much. See ya.
Thank you.